and that is not acceptable.
Yeah.
Because when things do go south in a mortgage loan, in a real estate transaction, it typically comes in the form of, hey, the realtor saying, hey, have you heard from your lender? What's going on with your loan? Are they going to be ready to close? And they say, well, I don't know. I haven't talked out. And then they call and they say, hey, is everything okay with the deal? And then so in those 10%, the people call back and say, well, there's an issue in underwriting, and the debt to income ratio, they're saying, and they blame it on, they push it all on the underwriter. The underwriter is saying that your debt to income ratio is too high, and I guess they didn't like the XYZ, and we're going to either need more down payment, or find a way to pay off your car, or maybe you can get a co-borrower. And it's like, I got to close in a week and a half. And now you're telling me that I got to
Right,
pay my
right.
car off if I want this
Yeah,
house that I've shown it to everybody. I've driven by with all my friends and family, and we're already
right.
planning. I got the movers scheduled. I got
Yeah.
all this stuff going on in my life. And now with a week and a half left, you're telling me that I got to get a
Well,
co-borrower? Like, what?
yeah.
And then the people are left in this mystery, like, what happened? Like, I guess it didn't. And then their friends and family, hey, so what's going on? What do they tell you? Well, I don't know. They said it was just something about debt to income ratio, and something about the debt to income ratio was too high. I don't really know what they're talking about, but they need me to get. And so that's where I say, first of all, you should know exactly what they're talking about.
Yeah.
That should not come up with a week and a half left. And because debt to income ratio is a very finite, objective, calculated, mathematical equation that's based on qualifying. Like, they should
Sure.
have known. They should have known whatever came up. They should have known that when you went to them for the first day to say, I want to buy a house and get pre-qualified. What can I buy? Like, where's my lending capability? And if they're not, looking, taking a bird's eye view over the business, and people that are not educated with who Fannie Mae and Freddie Mac are, and what the
Yeah.
automated underwriting software is by Fannie Mae and Freddie Mac, they get blindsided by this. So maybe we should dive into that, and I can do it as quick as I can, or maybe we need to
Yeah,
do
go
another
ahead.
podcast to get
The
into it.
room is yours.
But
Let's
I,
go.
so I explain to people that to understand mortgage lending, you got to understand Fannie and Freddie. And
All
Fannie
right.
Mae and Freddie Mac are mortgage banks, and they were created in the 60s and 70s in order to free up to buy loans from banks so that banks had more money to give to more people to buy houses. So
Okay.
every single loan that you get, every mortgage that anybody gets on a conventional side, now there's a lot of non-QM. We'll do another podcast about, alternative loans and non-QM
Sure.
stuff. But the standard mortgages that you get, you're going to be in four categories. It's going to be a conventional, conforming conventional loan, which
Hmm.
adheres to Fannie Mae and Freddie Mac's guidelines, a VA loan, or an FHA loan, or a USDA loan.
Mm.
So I'll ask people, a USDA loan is the Department of Agriculture. Those are really good loans insured by the USDA, and they're typically in ultra rural areas. If you're buying
Right.
a house in Phoenix, or you're buying a house in Memphis or Nashville or any, metropolitan area, it's not going to be in a USDA area. So most
Right.
people are not going to fall in that. And then the very next question I ask is, are you a veteran? Did you serve in the military? And if they did, then we're going to go straight to VA underwriting because it's the cheapest, best loan available. If they didn't, well, then they're not getting a VA loan if you're not a veteran. So that eliminates that. So then it really comes down to FHA or conventional. And so what is an FHA or conventional loan? Well, Fannie Mae and Freddie Mac. So if you take any mortgage that's given out by a bank. And you can either go to a big box bank that I call like a Wells Fargo or a Chase, Bank of America, and get a mortgage from them. You would never do that. I would never wish that on anybody because you're dealing with an hourly paid cubicle
Right.
warrior, I call them.
Right.
They're
Right.
not really that invested. Or you go to a mortgage bank like a Fairway Lending or a Rocket Mortgage or a VIP Lending or one of those
Right.
places, and they give mortgage loans. They're the bank that gives the loan. And if you go to Fairway, you get a loan from Fairway. If Fairway can't close your loan because they have their own little rules on top of Fannie Mae and Freddie Mac's rules, then you're not going to get a loan through Fairway, and then you're going to be
Right.
back on the street trying to find. Or you go to a broker like myself that can know which lenders out of 250 lenders that hundreds of lenders that are out there, which ones will give you the mortgage loan and all that. No matter who you go to, whichever avenue that you get a mortgage through, that mortgage has to adhere to the underwriting guidelines that are written by Fannie Mae and Freddie Mac for a
Right.
conventional loan.
Right.
Because all of those guys, all those lenders, whether it's a brokered lender, a direct lender, or a big box lender, they're doing a conventional mortgage loan and they're
Hmm.
expecting Fannie Mae or Freddie Mac to buy that loan so they get the
Right.
money back so they can give more loans out. And so
Right.
Fannie Mae and Freddie Mac, I call them the king and queen of all things mortgages in our country. They run the world in
Yep.
mortgage lending.
Yeah.
And they're kind of like Burger King and McDonald's. It's the same taste, it's just different packaging. So they have the
Yeah.
same rules, it's conventional rules. It's all very cut and dry. There's not a lot of gray area, although there's once in a while you can get an exception to one little minor detailed rule. But if you printed up a PDF of Fannie Mae and Freddie Mac's conventional mortgage underwriting guidelines,
Yeah.
and you
It's
go
almost.
and you pull up the
Yeah. It's
cell,
almost the same.
it's 1,300 pages long.
Yeah.
And so if you go and print, so the same bank will give you a conventional loan, or they'll give you an FHA loan, or they'll give you a VA loan, or whatever. And the only difference between an FHA, conventional, and VA loan is who insures the loan. So the
Right.
loan that you get has to be insured in case you default. And if you do default, and the lender then, I always joke with people like mortgage lending can be one piece of paper. I'm giving you money for the house, and if you don't pay the payment, I'm taking your house. Like
Right.
that's as simple as really as it is. But in that scenario where the bank has to take the house because you failed to make the payments, they're going to go ahead and sell that house. And maybe you've destroyed the house. And maybe they don't sell the house for as much as you owe on the house. So they're underwater on it. Who pays the bank the money that they lose in that scenario? And that's the insurer of the loan. The FHA, which is the Federal Housing Authority, insures FHA loans. So if you get and so because they're the ones insuring it, they get to write the rules on FHA loans. So they've bent the rules a little bit and they allow a little higher debt to income ratio, which we'll talk about. The VA insures their veterans loans. So if a bank
Yeah.
gives a VA loan based on the VA guidelines, they'll say, hey, if you lose any money on that, we got you. We're going to cover. It's like gap
Yep.
coverage on the auto. And then, so if you are putting less than 20% down on a Fannie Mae or a conventional loan through that gets, bought by Fannie Mae or Freddie Mac, you have to pay private mortgage insurance. So there's a private mortgage insurance company that insures that loan. Unless you put 20% down, then you're not required to pay for any of the mortgage insurance
And
because
that's
they figure
PMI
this
for
guy's
the
coming
average
out.
person.
That's PMI, private mortgage insurance. And they're coming out, they're thinking these people are coming out with a chunk of cash. They're not walking on that. They're going to make the payment. And even if they do struggle or they lose their job and they can't make the payment, they're just going to sell the house because they got the equity and we'll get our money. We're not worried about it. We don't require.
Right.
On an FHA loan, it doesn't matter how much you put down. You could borrow 10% of the purchase price and put 90% down. You're paying the FHA or mortgage insurance premium. They call it MIP. It's the same thing as PMI, only it's the government's version of it, which is what makes VA loans so great because they don't require any monthly mortgage insurance.
Mm.
They don't require you to pay for it. But here's the real kicker. Fannie Mae and Freddie Mac, They each have their own proprietary underwriting software. And it is, they call it AUS, which stands for Automated Underwriting Software.
Yep.
And any loan that gets funded by any bank has to have an automated underwriting software approval through either Fannie Mae's software or Freddie Mac's software. Fannie Mae's software is called desktop underwriting. They call it DU. Freddie Mac's software is called Loan Processor Assist, or they call it LPA. So you have to have an LPA or a DU software, automated software approval, and it is nationwide, universal.